Today we are breaking down 𝗗𝗏𝗧𝗖𝗢𝗗𝗘's take from CNBC, where he and Ross Mayfield argue that tech weakness is normal, AI remains the core growth engine, and a broader sector rotation could actually be healthy for investors. 𝗗𝗏𝗧𝗖𝗢𝗗𝗘 says, every AI pullback has been a buying opportunity, and that tech is far from finished, though investors should expect big pullbacks along the way. I'm going to show you the clip of 𝗗𝗏𝗧𝗖𝗢𝗗𝗘 on CNBC. Right after that, I will walk you through my reaction and give you a detailed breakdown of everything he said. Then I will go deeper and share my top 3 cheap tech stocks to buy right now based on his thesis and the current market backdrop. If you only watch one video today, make this the one, and stay until the end. Hit the like button, help us get to 1,000 likes on this video, share it with someone who cares about tech and AI, and drop your thoughts in the comments below. Subscribe so you do not miss the next important investing update. Alright, let us watch 𝗗𝗏𝗧𝗖𝗢𝗗𝗘 and then I will give you my take.
We've talked a lot over the course of the last several quarters and maybe even multiple years now about the secular bull run in technology. Is it over?
I think we should expect from time to time profit taking because tech has been a leader for the last decade, and it is overbought. So I think it is going to be from time to time going to show extended weakness. But to me, the underlying story driving technology, which is the productivity miracle coming from AI, is still intact. Mary Erdos even talked about this earlier this week from JP Morgan, that there's been a payoff in spending, and Lisa Su at AMD as well as noting that productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks.
Tom, if I could just follow up, you manage funds now, especially an ETF that's heavily tilted in some ways towards some parts of that kind of technology, media, and telecom trade. Has anything changed with regard to the price action or the fundamentals that have taken some of those names perhaps out of your portfolios?
Dom, we just actually did a rebalance for the 𝗗𝗟𝗏𝗧𝗖𝗢𝗗𝗘 ETF, our large cap fund. We still actually have about 40% exposure to tech. It's about a market weight, but to us, the visibility and the spending is still very strong, and names like NVIDIA are still reasonably priced. I mean, NVIDIA at 28 times forward earnings is still less expensive than buying Walmart or Costco. Costco is almost 50 times forward earnings.
All right, Ross, with that in mind, as you watch the price action play out, does it surprise you at all that we've seen this kind of a sell-off? Could we expect more of this in the coming weeks?
I don't know if we'll get more of it, but investors should expect more of it. I mean, if you look even at the late 90s, during the heyday of the dot-com bubble, 96 double-digit sell-off, 97 double-digit sell-off in the NASDAQ, 98 big sell-off on LTCM and some other weakness, and then 99 even big sell-off in the NASDAQ. So double-digit sell-offs even in bull markets driven by new technologies and exciting new technologies are really common. And this one, is just par for the course, I think, amid a broader bull market. So as long as the technicals and the underlying trend isn't too damaged, I think it is a dip you can buy. But I think investors should always expect a little bit more weakness. We've been on a tremendous run off the April lows. That kind of momentum can't sustain forever.
Ross, do you feel as though there is any kind of a case to be made for a possible rotation trade? We've been exploring the possibility that maybe this broadening out could include less AI and tech and more things like perhaps energy or financials, something else along those lines. Does that thesis play out in the coming quarters in your mind?
Sure. And I think it's incredibly healthy that as AI is pulling back, we're getting some nascent leadership from things like energy. Healthcare has had a tremendous month thus far after being really beaten up for a couple of years. Financials, big banks, both in the U.S. and globally, have held up solidly. So, obviously the headline indexes are going to be weighed if big tech sells off. But I think it's incredibly healthy both on the earnings front and on the price front that you're seeing some breadth, especially at a time when the question about the broader economy outside of AI is how healthy is it, right? So this is a really good sign to me, and I'm happy to take a little bit of gains from tech and rotate into some nascent leadership there in other sectors.
Tom, the tariff tantrum issues aside from earlier this spring, specifically in April, we haven't really seen any kind of a pullback last that long. It seems like these things are getting shallower, they're getting shorter in duration. If it is the case here, does it still play out that way? And if so, what exactly then goes on shopping lists? I mean, you mentioned your ETF 𝗗𝗟𝗏𝗦 𝗗𝗟𝗏𝗘. Is there anything that you would be thinking about buying more of? I know that the rebalance is already there, but what kind of stocks actually go and you want to buy on discount here heading into the year end?
Yeah, well, I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means that ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback, but for the last 5 years, investors have had to buy that pullback.
Ross, we'll give you the final word here. Does the Fed need to cut rates in December for this market rally to keep going?
They don't need to cut rates to keep the rally going. I think they should cut rates. I think there's enough labor market weakness and there's not enough upside pressure from inflation that they should be at least getting to their neutral policy stance with some haste. I don't think there's any reason to pause. We don't have any data, so I don't know what has caused the hawkish turn. Obviously, the underlying economy is not in recession. It's fairly healthy, but we're in a restrictive stance. I think we could get to a neutral policy and then go from there. I don't think they need to cut. I just think they should.
All right. I lied because, Tom, I'm going to give you the last word. I want to hear what you think. Does the Fed need to cut rates for this rally to continue?
I think from a market's perspective and from the economy's perspective, we know that high rates are actually causing pressure on the housing market. That is, something that I think the Fed actually has some can actually have some impact on. So I do think it makes sense for the Fed to cut.
So Tom Lee kicks things off by addressing the question that a lot of people have been whispering lately. Is the secular bull run in technology finally over? And Tom does what he always does. He steps back and takes a longer view. He admits that tech has been the leader for more than a decade, and because of that, it is absolutely normal to see profit-taking in periods where the sector gets overbought. But to him, that does not mean the story is finished. In fact, he emphasizes that the big underlying driver of tech today is still very much alive. That driver is AI-driven productivity. He highlights comments from Mary Erdos at JP Morgan and Lisa Su at AMD, both saying that the payoff from AI investment is real and growing. In Tom's eyes, that is still a major tailwind for tech. So even though the price action can look weak at times, the structural story remains intact. Then the interviewer presses Tom a bit more on how this affects his own fund, especially the ETF he manages, which is heavily exposed to tech. Has anything changed in terms of fundamentals or price action that made him abandon some of these tech names? Tom says no. In fact, they just rebalanced their Granny Shots ETF, and they still hold around 40% in tech. That is a market weight position, and he stands by the thesis because the visibility into future spending remains strong, and he makes a comparison that probably caught a few viewers off guard. He says that Nvidia, even after all its growth, is trading at 28 times forward earnings. Meanwhile, Costco is trading closer to 50 times earnings. So in his view, Nvidia is not even expensive when you consider the growth potential ahead. After that, we shift over to Ross Mayfield, who is asked whether the recent sell-off surprises him, and Ross gives a very historical answer. He reminds everyone that even during the most explosive bull market of the late 1990s, the Nasdaq still experienced double-digit pullbacks almost every single year. 1996, 1997, 1998, 1999. All of them had notable corrections even while tech was booming. So what we are seeing now is not abnormal. If anything, it is expected. He says investors should always expect a little more weakness, especially after a strong run off the April lows. That level of momentum cannot last forever. But to Ross, the pullback is not a bad sign. If the technical trend stays intact, dips like these can actually be opportunities to buy. Ross is then asked whether we might see a rotation away from big tech and into other sectors like energy, healthcare, or financials, and he actually thinks that is a very healthy development. He points out that as AI pulls back, we are starting to see early leadership from other sectors. Energy is showing life. Healthcare is having a great month after years of weakness. Global and U.S. banks are holding up well, so although weakness in big tech weighs on headline indexes, This kind of broadening is a positive sign for the overall market because it shows the economy is not dependent on just one sector. And he personally says he is happy to take profits from tech and reallocate into areas showing new strength. Then the conversation flips back to Tom Lee. The interviewer brings up the idea that recent pullbacks are becoming shorter and shallower, and asks Tom which kinds of stocks he would be buying now while prices are discounted. Tom once again zooms out and talks about the economic backdrop. He says the Federal Reserve is hesitant to cut rates in December, but the reason they are hesitant is actually a good thing. The economy is healthier than expected, wages are still strong, and inflation has not yet given the Fed a predictable path forward. But a healthy economy is positive for corporate earnings and business confidence. And if business confidence improves, Tom expects ISM readings to recover, which leads to broader market strength. That includes small caps, which he says have suffered badly, while the Fed maintained a hawkish stance. Tom also agrees with Ross that a broadening trade is likely, but he still loves tech because every time the AI trade gets questioned, it pulls back and then resumes its climb. He reminds viewers that for the past 5 years, buying AI-related pullbacks has rewarded investors. After that, Ross is asked whether the market needs the Fed to cut rates in December for this rally to continue. Ross says the market does not need it, but the Fed should cut anyway. He believes there is enough labor market weakness and not enough inflation pressure to justify staying this restrictive. In his view, the economy is not in recession, but policy is tighter than it needs to be. He wants the Fed to get back to a neutral stance sooner rather than later. And finally, Tom Lee is given the absolute last word. The interviewer asks whether the Fed needs to cut rates to keep the rally alive. Tom says from both a market and economic standpoint, high rates are absolutely putting pressure on the housing market and causing strain elsewhere. His message is clear. Rate cuts would help, but the market does not require them to move higher as long as earnings remain strong and business confidence improves. So when you put all of this together, here is the real takeaway. Tech is not dead. The AI story is still powerful. Pullbacks are not only normal, but expected. Rotation into other sectors is a sign of a healthy market. Small caps and banks may finally get their turn. And the Fed's next moves will not necessarily make or break the rally, but they will influence the speed and breadth of it. It is a complex moment in the markets, but it is also an opportunity-rich environment if you know where to look. And both Tom Lee and Ross Mayfield are saying the same thing in their own ways. The bull market is still alive. It is just evolving. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's dive into the 3 cheap tech stocks to buy now. First up is Taiwan Semiconductor Manufacturing, ticker symbol TSM, the world's largest and most advanced semiconductor foundry. Founded in 1987, TSM has grown from a regional player into a global powerhouse, fundamentally shaping the modern electronics industry. Today, it's not just a company, it's the beating heart of the world's technology supply chain, producing the chips that make our digital lives possible. TSM makes the chips that power everything from iPhones to AI servers, serving tech giants like Apple, Nvidia, and AMD. Its client list reads like a who's who of the tech world, and its chips are found in billions of devices, smartphones, laptops, data centers, electric vehicles, and even household appliances. If you've used a modern gadget, chances are TSM played a role in making it work. Despite its critical role, TSM trades at a discount due to geopolitical fears about its location in Taiwan. The island's proximity to China and ongoing tensions in the region have made some investors nervous, leading to a valuation that doesn't fully reflect TSM's dominance. Yet, this risk is also what creates a unique opportunity for long-term investors. But, here's the reality. TSM's technological lead is massive, and building a competing fab costs tens of billions, making its moat nearly unbreakable. The company's expertise in advanced process nodes like 3 nanometer and beyond puts it years ahead of rivals. Even the world's largest companies struggle to match TSM's scale, efficiency, and know-how. Its manufacturing process is so complex and capital-intensive that only a handful of players can even attempt to compete. The company's relentless R&D keeps it ahead in chip technology, locking in clients and ensuring consistent revenue growth and strong margins. TSM invests billions every year into research, pushing the boundaries of what's possible in chip design and manufacturing. This commitment to innovation means its customers, some of the most demanding in the world, keep coming back, year after year. Geopolitical risks are real, but TSM is actively diversifying with new fabs in the US, Japan, and Germany, reducing its single point of failure risk. By expanding its manufacturing footprint globally, TSM is working closely with governments and partners to ensure supply chain security and resilience. These new facilities will not only serve local markets but also help TSM weather any regional disruptions. As the world's demand for advanced chips grows, driven by AI, cloud, and smart devices, TSM stands at the center, manufacturing the future. The explosion of artificial intelligence, the rise of connected devices, and the shift to cloud computing all depend on TSM's ability to deliver ever more powerful and efficient chips. In many ways, TSM is the silent engine behind the next wave of technological innovation. The stock's valuation is compelling, a lower P/E than peers, a solid dividend, and a dominant market position. TSM offers a rare combination of growth, profitability, and shareholder returns. Its financial discipline means it can reward investors while still investing heavily in the future. For those seeking both stability and upside, TSM stands out in the crowded tech sector. TSM is a long-term compounder, not a get-rich-quick play. It's the backbone of global tech, and the market is underpricing its importance. As the world becomes more digital, TSM's role will only grow. Its chips are the foundation for everything from smartphones to supercomputers, making it indispensable to the modern economy. While others chase the latest AI software, you can own the company that makes it all possible. TSM is the enabler, the company that turns cutting-edge ideas into physical reality. Without TSM's chips, the AI revolution simply wouldn't happen. TSM's resilience through supply chain shocks and political tensions proves its stability. Even during global crises, TSM has kept production running, meeting the needs of its customers and maintaining its reputation for reliability. This track record gives it a unique edge in a volatile world. As it expands globally and advances chip technology, the valuation gap with its peers should close. Investors who look past the headlines and focus on fundamentals may find themselves well rewarded as TSM's true value is recognized. With a market cap around $1.45 trillion and a P/E ratio in the high 20s, the company continues to command a premium valuation. Earnings per share come in at 9.74 in new Taiwan dollars. Revenue for the year reached about 2.89 trillion new Taiwan dollars, and net income was over 1.15 trillion new Taiwan dollars. When you look at the valuation and profitability, the strength becomes obvious. A P/E ratio around 27 and an enterprise value to EBITDA near 16 show that investors trust the company's long-term advantage. Free cash flow growth is almost 200%, which is extremely rare for a company of this size. Gross margin sits above 56% and operating margin above 45%, a combination that reflects world-class efficiency and pricing power. This is a highly profitable, cash-generating business that deserves the premium the market assigns to it. For investors seeking quality and value, TSM is a rare opportunity, a world-class asset at a discount. Its combination of scale, technology, and financial strength is unmatched in the industry. It's the definition of a cheap tech stock to buy now. Few companies offer this blend of growth, resilience, and value in one package. Let's move to our next pick. Scene transition. Next up is Supermicro, ticker symbol SMCI, a company that's become a linchpin in the ongoing AI infrastructure boom. While many investors focus on the big names in artificial intelligence, Supermicro is quietly powering the backbone of this revolution, providing the essential hardware that makes AI possible at scale. Supermicro specializes in building high-performance, customizable servers that are absolutely critical for AI workloads, data centers, and cloud computing environments. Their products are the workhorses behind the scenes, handling the massive data processing and storage needs of today's most advanced technologies. What sets Supermicro apart is their unique building block approach. This modular design philosophy allows them to rapidly assemble and deliver tailored server solutions to meet the specific needs of each client. In a world where technology is evolving at breakneck speed, being able to quickly adapt and deploy new systems is a massive competitive advantage. Their close partnerships with leading chip makers like NVIDIA and AMD mean Supermicro is often first to market with the latest and most powerful hardware. This gives their customers early access to cutting-edge technology, which is crucial for staying ahead in the AI arms race. The company's stock has experienced a meteoric rise, reflecting the surging demand for AI infrastructure. Yet, despite this impressive run, SMCI's growth is so rapid that its valuation remains compelling. Its price-to-earnings growth, or PEG ratio, often signals that the stock is still undervalued compared to its future earnings potential. Supermicro is also at the forefront of efficiency, with a strong focus on advanced liquid cooling technologies. These systems not only save clients significant amounts of money on energy costs, but also allow for denser, more powerful server configurations. In the world of AI, where every watt and every square inch counts, This is a game changer. By reducing heat and improving energy efficiency, Supermicro's solutions help clients meet increasingly strict environmental standards while also boosting performance. This focus on sustainability is becoming a key differentiator as data centers grow larger and more power-hungry. The company is founder-led, with CEO Charles Liang at the helm since its inception. This engineering-driven culture means Supermicro is both agile and innovative, able to pivot quickly to meet new challenges and opportunities. Their leadership is deeply aligned with shareholders, fostering a long-term vision for growth. The AI server market is projected to explode in the coming years, as more industries adopt machine learning and data-driven technologies. Supermicro is perfectly positioned to capture a significant share of this growth, thanks to its reputation for quality, speed, and customization. Unlike the slow-moving giants of the industry, Supermicro operates more like a nimble speedboat than a battleship. They can adapt quickly to changing market demands, winning business from hyperscalers, research labs, and enterprises that need rapid deployment and cutting-edge performance. Of course, with rapid growth comes volatility. SMCI's stock price can swing dramatically in response to market news or earnings reports. But for long-term investors who believe in the AI infrastructure story, these pullbacks can present attractive buying opportunities. Another key selling point is Supermicro's reputation for quality and its commitment to US-based assembly. In an era of increasing geopolitical tensions and supply chain concerns, many major clients value the reliability and security that comes with American manufacturing. The company's flexibility and speed are hard for larger competitors to match. Their ability to quickly design, build, and deliver custom solutions means they can serve a wide range of clients, from Fortune 500 companies to cutting-edge startups. Customers consistently praise Supermicro for their responsiveness and technical expertise. This reputation for service and innovation has helped them build strong, lasting relationships across the tech industry. Of course, there are risks. Execution missteps or increased competition could threaten their lead, but Supermicro's head start, operational excellence, and deep industry relationships create a strong moat that's difficult for rivals to breach. With a market cap just over $21 billion and a PE ratio around 28, SMCI is much smaller but still carries big expectations. Earnings per share stand at $1.27, revenue is just under $22 billion, and net income is slightly above $1 billion. One of the biggest shifts is in investor sentiment. The PE ratio surged from around 17 in early 2025 to nearly 36 within a year, even as revenue growth cooled sharply from over 150% to about 12%. Free cash flow growth remains strong at more than 90%, which is encouraging, but profitability is tightening. Gross margin has fallen to around 10% and operating margin is down to roughly 4%. That margin compression suggests rising costs or shrinking pricing power. When rapid revenue growth slows and margins tighten at the same time, investors need to be cautious and look closely at the operational challenges hidden beneath the surface. For investors seeking explosive growth, SMCI offers a pure play on the AI infrastructure revolution. As demand for AI computing power accelerates, Supermicro stands to benefit from every new wave of innovation. In many ways, Supermicro is the ultimate picks and shovels play, providing the essential tools and hardware that enable the entire AI ecosystem to thrive. Without companies like SMCI, the AI revolution simply wouldn't be possible. Now let's turn our attention to our final, and perhaps most unconventional, pick in the world of AI investing. Our third pick is Strategy Inc., ticker symbol MSTR, a company that stands out as a fascinating hybrid of traditional enterprise software and a bold headline-grabbing Bitcoin strategy. MicroStrategy isn't just another tech stock, it's become a lightning rod for investors who want exposure to both the world of business intelligence and the explosive potential of cryptocurrency. Founded in 1989, MicroStrategy has spent decades building a reputation as a leader in analytics and data solutions. But, in recent years, it's made waves for a very different reason. At its core, MicroStrategy's primary business is providing business intelligence software to some of the world's largest organizations. Their platforms help Fortune 500 companies analyze massive amounts of data, make smarter decisions, and drive efficiency. This software business generates reliable, recurring revenue and steady cash flow, which is the foundation that supports everything else the company does. It's a business that's proven resilient through tech cycles, and it continues to evolve with the needs of modern enterprises. But what truly sets MicroStrategy apart is the vision and audacity of its CEO, Michael Saylor. In 2020, Saylor made a radical move. He began converting the company's cash reserves and even taking on debt to buy Bitcoin. Today, MicroStrategy holds over 200,000 Bitcoin on its balance sheet, making it the largest corporate holder of Bitcoin in the world by a wide margin. This isn't just a side bet, it's a core part of the company's identity and strategy, and it's turned MSTR into a proxy for Bitcoin itself. When you buy MSTR stock, you're not just investing in a software company, you're also getting leveraged exposure to Bitcoin's price movements. The company's massive Bitcoin holdings mean that its stock price often moves in tandem with Bitcoin, but with even greater volatility. For investors, this creates a unique opportunity. You get the upside potential of Bitcoin, plus the underlying value and cash flow of a real operating business. This structure is especially attractive to institutional investors and funds that, for regulatory or policy reasons, can't buy or hold cryptocurrency directly. By owning shares of MicroStrategy, they can gain indirect exposure to Bitcoin through a familiar, regulated equity. It's a creative workaround that's helped MSTR attract a diverse set of shareholders, from tech enthusiasts to traditional Wall Street players. However, this approach comes with significant risk. Because MicroStrategy has used leverage, borrowing money to buy even more Bitcoin, its stock price doesn't just follow Bitcoin, it amplifies its moves. When Bitcoin rallies, MSTR can soar even higher. But when Bitcoin falls, the stock can drop sharply too. This high-risk, high-reward dynamic makes MSTR one of the most volatile stocks in the market, and not for the faint of heart. Michael Saylor's unwavering conviction in Bitcoin and his willingness to use sophisticated financial engineering have attracted a loyal following among investors. Many see him as a visionary who's ahead of the curve, while others view his strategy as reckless. Regardless, the company's software business continues to generate cash flow, which Saylor uses to buy even more Bitcoin, reinforcing the company's unique flywheel effect. If Bitcoin's price experiences a major surge, MicroStrategy's value could skyrocket due to its leverage structure. The company's stock has already seen dramatic gains during past Bitcoin bull runs, rewarding those who believed in Saylor's vision. For investors who are bullish on Bitcoin's long-term prospects, MSTR offers a way to potentially multiply those gains even further. MicroStrategy's capital strategy is another key part of the story. By issuing low-interest convertible debt, the company has been able to raise billions of dollars at favorable terms, using that capital to buy more Bitcoin. This approach manages risk by locking in low borrowing costs, while maximizing upside if Bitcoin appreciates. It's a bold financial maneuver that few other companies have attempted at this scale. Beyond just holding Bitcoin, Saylor and his team are exploring ways to integrate Bitcoin and blockchain technology into MicroStrategy's core software offerings. This could open up entirely new markets and use cases, from secure data sharing to decentralized analytics, potentially unlocking new growth opportunities for the company. In this way, MicroStrategy isn't simply a Bitcoin holding company. It's actively building real-world applications on top of the Bitcoin network, aiming to bridge the gap between enterprise software and decentralized finance. This dual focus could position the company as a leader in the next wave of digital transformation. When people talk about MicroStrategy's cheapness, it's not about traditional metrics like price-to-earnings ratios. Instead, it's about the unique leveraged exposure to a transformative asset, Bitcoin, combined with the stability and cash flow of an established software business. For investors who understand the risks, this combination can be incredibly compelling. Ultimately, MSTR is a high-conviction, contrarian bet. It's for those who believe in Bitcoin's long-term story and want to amplify their exposure through a company that's all in on the digital asset revolution. It's not a safe, steady play, but for the right investor, it could be a game-changer. While there are alternatives, like Bitcoin ETFs or mining stocks, none offer the same combination of leverage, business model, and visionary leadership. ETFs track Bitcoin's price, and mining stocks depend on operational efficiency and energy costs. MicroStrategy, on the other hand, is a pure, leveraged bet on Bitcoin's future, with the added kicker of a profitable software business. The company's strategy is refreshingly transparent: accumulate and hold Bitcoin for the long term, using the cash flow from its software business to fuel this ongoing accumulation. This creates a powerful flywheel effect, where success in one area drives growth in the other. With a market cap of about $57 billion and a PE ratio that has come down from the mid-20s to the low teens, the stock appears more attractively valued at first glance. Earnings per share are over $24, but annual revenue sits below $500 million. The financial picture becomes far more complicated when you examine the details. Earnings growth looks explosive because of one-time factors, including crypto-related gains, rather than consistent core operations. Gross margin is strong at over 70%, but the operating margin figure in the snapshot is extraordinarily high, in the thousands of percent, which signals that non-operating items are heavily distorting the picture. The company even reported a net loss in one period despite those massive margin numbers. MicroStrategy is a classic case of a stock driven by external variables, where headline metrics can look spectacular one quarter and reverse dramatically the next. Investors must separate real business performance from financial noise. For those seeking high-octane potential and who have conviction in Bitcoin's future, MicroStrategy is one of the boldest ways to play the trend. It's a stock that can deliver outsized returns, but also comes with significant volatility and risk. In the end, MicroStrategy represents a fascinating blend of old-school enterprise technology and cutting-edge digital finance. If the thesis plays out and Bitcoin becomes a truly transformative asset, MSTR could be positioned for extraordinary upside, making it a compelling, if unconventional pick for forward-thinking investors. There you have it, 3 tech stocks trading at a discount to their long-term potential. TSM, the tech industry's backbone, SMCI, the AI infrastructure leader, and MSTR, the bold Bitcoin bet. Each offers a unique risk-reward profile, so do your own research and see which fits your strategy. Want deeper analysis and real-time alerts? Join the Stocks Galore Patreon, link in the description. Which of these stocks do you think has the most upside? Drop your pick and reasoning in the comments below. Don't forget to like, subscribe, and hit the bell for more investing insights. Thanks for watching. See you in the next one.